Adjourned, correct? We're all okay.
Yeah.
So I'd like to call the investment committee meeting to order. And Ellen, I'll ask you to take a roll call, please.
Certainly. Good morning, everyone. Trustee Bartholomew.
Yes.
Trustee Gardner.
Here.
And we're expecting Trustee McMahon and Trustee Donnelly a little bit late. Trustee Martin.
Here.
We're all set. We do have a quorum.
Excellent. I want to remind everybody that the meeting, during the meeting, to leave your mics on mute when you're not speaking. And just wanted to give a brief, just discuss briefly what the investment committee's been very busy, as you all know. We've all been participating, and I really appreciate all the time that you've committed to the special meetings. At the April 28th meeting, the investment committee voted to approve the investment statement. The investment policy statements have been updated and posted to the web. We could send that all to you for your review. And just wanted to also say that we have completely divested from our direct holdings. So I'm not going to steal, I'm going to have Kelly talk about that when she discusses the ESG fossil fuel exposure on the details, if you have questions. But pretty pleased with our progress. Feel we're in a good place. It was a good compromise. Also, I'm not sure if many of you heard Robbie Feinberg's NPR story on UMS divestment. I believe that was shortly after the meeting. It was either the 29th or the 30th. And he did get quite a bit of information. A lot of people were quoted on it, either from our YouTube live stream, or one of them in particular that I want to discuss was Charlie Cooper, one of the students from Divest UMS, and some of the things that Charlie had told Robbie in the interview was the latest action that the UMS investment committee has taken is a significant step forward. He was pleased with the short-term commitment to end direct fossil fuel holdings. As always, they're going to continue to work to keep the university accountable through change of trustees and administration and whatnot. And he felt that the long-term goal of 2030 is pretty reasonable. So, it was good. It was good to hear that. I think we struck a good compromise where we're able to hold true to the fiduciary responsibility, but also do the right thing for the planet. So anyway, I wanted to share that with everybody. And without further ado, I will transfer the agenda, tab 1, to Cap Trust to review the defined contribution plan quarterly review.
Great. Okay. Well, thanks very much, Kelly. And again, good morning to everyone. Today, hopefully, should be a fairly straightforward quarterly review. I know we have a fairly short amount of time on the agenda, so I'm going to cover some industry updates, take about maybe 10 minutes to go through some industry updates. And then I'm actually thrilled to be able to hand it over to Barry to cover the markets this quarter. So
Yay.
Barry will cover things that are going on in the markets, and then he'll also be able to talk specifically about the UMaine system plan and the investments, which, frankly, have held up pretty well on a relative basis. Certainly not immune to market downturns, but overall, I think have held up pretty well. So I'm going to go ahead and share my screen. And hopefully everyone can see that. And just some really quick industry updates. I think that there's certainly been some interesting things in the press, some things that will impact your plan down the road, other things that won't have an immediate impact on your plan, but I still think are worthy of discussion. But I think everyone saw that the Secure Act did pass the House since the last meeting. We certainly think that's good news. The Secure Act, which is kind of being referred to as Secure Act 2.0, it's still just an evolving version of the original Secure Act, I think is going to have some very meaningful things that will positively impact retirement plans in general, and certainly the Humane System Plan. Also, as you can see in the upper left-hand corner, the IRS did release some proposed required minimum distribution regulations, which includes some payout provisions, which frankly are somewhat complex. I'm not going to cover them today because we're still waiting to see more of a compromise version between what the IRS has released, what the Secure Act that was approved in Congress, and then ultimately what will come out of the Senate with the Secure Act as well. But again, I think there's some really interesting and I think positive things in the Secure Act. We do expect the majority of it to pass, increasing required minimum distributions to 75. That's kind of gradually gone up from 70.5 to 72. Potentially an additional catch-up provision for people between age 62 and 64, where people in that age bracket can actually contribute an additional amount. There's some unique and I think some really nice student loan features that will help with some of the student loan debt in the country, excuse me. And then also the ability to potentially designate matching contributions as Roth. So these are all things that, more to come. The big one, and this is the one that we've really talked about, for at least 2 quarters now, is the ability for 403B plans to invest in collective investment trust vehicles, something that 401k plans, frankly, have been eligible for years, if not decades. The beneficiary to that would be large 403B plans. Certainly the Humane System falls right into that category, and an immediate impact on your plan, for example, would be the ability to transition from the current Vanguard target date institutional shares to the CIT or collective investment trust version of that, which could potentially save anywhere from 100 to 200 basis points expense ratio on those target date funds, which obviously isn't a huge number, except when you start to apply it to, over $250 million in target date assets. And since it's your default option, we certainly envision that to continue to be the biggest growth area of your plan as well. So again, those are all things that I just want to assure committee members we're keeping a very, very close eye on, and we'll keep you posted and immediately come to the committee with recommendations, if and when there are things that will benefit your plan. The other update, which isn't on this page, is that TIAA recently introduced some zero revenue sharing share class funds. And again, these are things that we're currently evaluating. We've been talking to members of this committee, Tracy and Kelly, about the potential for benefiting the plan using those zero rev share funds. And again, just wanted to make sure that people were aware that we're certainly on top of that. We're not ready to make any type of immediate recommendations, but if you see that in the press, I think that's something that we just wanted to let you know we're on top of. The final thing on this page, which I think is fascinating for people, and there is a bit of an action item here as well, and that's the DOL guidance on cryptocurrency. I believe we may have talked briefly about this last quarter as well, but in a very surprising move, the DOL has released some guidance related to self-directed brokerage accounts, something that frankly, we've been waiting for guidance relative to self-directed brokerage accounts for about 20 years and haven't gotten a lot. But the Department of Labor feels so strongly that cryptocurrency investments should be discouraged in self-directed brokerage accounts that they did release some guidance and essentially said that if you allow cryptocurrency in self-directed brokerage, it may trigger additional fiduciary responsibilities for oversight of self-directed brokerage accounts. We don't think that's anything that you would want, or certainly that we would want as advisors to the plan. So we think that it's really important to just formally notify TIAA that you want to prohibit investments in cryptocurrency within the self-directed brokerage account. And again, I think that the DOL has made it easy here in that if you do have participants that are asking for the ability to invest in crypto through brokerage, the fact that you're following DOL guidelines and guidance, I think makes that decision very, very easy because again, no one wants that additional fiduciary responsibility. So we'll certainly work with Tracy on the language around notifying TIAA. It's really a very simple, we've done this with other TIA clients. They have a process in place. And again, at some point down the road, cryptocurrency may be a very logical diversifying asset class in retirement plans. We don't think we're quite there yet. Of note, after this guidance came out, Fidelity came out with a major announcement that was front page Wall Street Journal, that they were going to allow cryptocurrency in retirement plans as a core investment lineup. And there's certainly been a lot of fallout from that announcement and that decision. And the DOL kind of went back to Fidelity to discuss that decision. And Fidelity has actually walked back that announcement just slightly as well. So again, crypto is very, very new. It's very hard to understand. It's certainly very, very hard to, in some cases, get out of from a liquidation perspective. So we think the logical thing at this point is to follow that DOL guidance as well. So, any questions on anything kind of topical spotlight related? Okay, there's a couple of other slides in there I won't spend a lot of time on, but I did want to point them out about a retirement income strategy. This is something that TIA certainly, I would argue, is a leader in the market on kind of transitioning from the accumulation phase to the distribution phase of retirement plans. And so there's a slide in there on that. And then finally, I wanted to point out that we do have some statistics in the packet around self-directed brokerage accounts specifically. And I think that this is just really of interest because you obviously do offer self-directed brokerage, and you can see that you're really right in with the norm there. If you look at over on the right-hand side, you can see 403B plans with $1 billion plus in assets. Almost 70% of those plans do offer self-directed brokerage. So we continue to think that, that's a logical choice, and giving people the ability to maybe get into some diversifying asset classes that aren't part of your core investment lineup. And with that, I think I will pause and see if there are any questions on anything that I covered before I turn it over to Barry to talk about markets and the plans specifically. Okay, so I'm going to stop my screen share, Barry, and turn it over to you.
Awesome. Thank you. So, clearly this is not a strong market by any stretch of the imagination. And I'm just flipping back to the pages I want to cover. I apologize here. I should have had that already pulled up. If we look at kind of where we were at the end of March, you think about the last several trading days of March, we had a little bit of a market rebound, so it muted some of the underperformance through the end of March. You look at some of these numbers, U.S. large cap stocks at the end of March were down about 4.6%, developed international down about 6%. Even U.S. bonds, obviously, a haven, which has not necessarily been a haven so far this year, down about 5.9%. You don't have these numbers, but I wanted to give you at least an indication of kind of where we are as of the end of yesterday. Obviously, there's further deterioration, and we'll talk about that in a minute in terms of some of the root causes. But through yesterday, the S&P 500 is down about 17%. Mid cap is down about 17.5%, 18%. Small cap is down about 20%. If we go international, EFA, the developed international, is down about 14, a little over 14%. Emerging markets down about 16%, and aggregate bonds are down now about 9.7%. So we've had further deterioration, since the end of March. And I'll go right to kind of the crux of what we're seeing in the marketplace. Clearly, inflation is here for a while. The Fed clearly, based on the pandemic and the various stimuluses, the accommodative policy that's taken place, is now created a situation where inflation is really probably the number one concern of the Fed at this point. When we see year-over-year inflation up over 8%, we've not seen that in over 40 years. You all have probably seen that and experienced that when you go to the grocery store, when you fill up your gas tank. It's been kind of an incredible and pretty quick rise in terms of the inflationary front. And that's so the Fed is really it's very challenging what they can do. They certainly have already indicated that they're going to raise rates, and I think the market has baked in another 250 basis point rate hikes over the coming months. At the same time, the Fed is worried about the slowing U.S. economy, and if you saw probably within the last couple of days, Walmart had earnings miss, Target had earnings miss, so retail sales are really a leading indicator of that. And so I think Target was down about 25%, Walmart down about 17%. So, the Fed is challenged to say, okay, the economy is slowing, but at the same time, we need to combat inflation. So we don't see anything in the marketplace currently that has is alleviating the particular current market situation. So we do think over the next quarter or so, we're going to continue to see this negative volatility in the marketplace until we were talking before, like we don't necessarily see a bottom at this point. We think there will be a bottom. We're not exactly sure where it is at this point because the market has kind of blown through. The S&P has blown down through the 4,000 barrier. It's now down less than 3,900. So we do think it's a really difficult and challenging market as we speak. And then you think about the war in Ukraine and just the humanitarian crisis that we are experiencing live stream, and that's just exacerbated from a capital markets perspective. Certain commodities, oil and energy prices for sure, other types of commodities that are produced by and exported by both Ukraine and Russia. I want to end more on the tailwind side, but these are certainly some things that we're looking at driving the markets, at least from a tailwinds perspective. The consumer balance sheets are strong. However, it's quickly waning given the fact that inflation is where it stands today. If we looked at this was written probably the second week of April. The market has certainly shifted more negative since that point in time. So the U.S. consumer, I would say, is remaining strong, but now waning in terms of the overall inflationary market. Healthy profits, when we looked at first quarter performance, by and large, companies were earning in terms of expectations. However, more recently, I mentioned the Walmarts and the Targets of the world. Not only are they're having more recent earnings mixes, they also are reducing their forward-looking earnings projections. I think Target had highlighted the increased transportation costs to the tune of about $1 billion a year in higher transportation costs. So again, that's going to further exacerbate this particular market environment. While the COVID conditions have improved across the U.S., we don't anticipate anything unforeseen for sure, but we don't anticipate any more significant lockdowns. However, when you look at China, China and Shanghai and their zero COVID policy has really created and exacerbated some supply chain issues with respect to the Shanghai region in particular. So while COVID for U.S. is more of a tailwind, it's still an issue that will not resolve itself for any period of time soon. I know this is a really rosy picture of the current market malaise. This is an interesting chart. We don't typically go through all of these. I'll highlight a couple, but you can see kind of the export ranks. Russia is number 2 in terms of exports of crude petroleum. You can see the top importers. You look down, the third down, wheat, 29% of the world's wheat. It comes from Russia, Ukraine, and, Russia is the number 1 exporter. This is something I never realized, and Ukraine is the number 5 exporter. So, clearly it's created an issue with respect to prices and with respect to supply chain. The other thing we're seeing in the marketplace is if this is really just stack ranking major asset classes by performance, and you look at the first quarter, the first quarter of 2022, cash was the best performing asset class. But you look at the bottom of this page and you see, in fact, I can highlight this a little better. Large, mid, and small are the worst three performing sectors of the marketplace. And then you go back to 2019, 2020, the top performing asset classes in 2019 and 2020, large, mid, and small. And what we've seen, and probably this is the latter part of 2021, we're starting to see this kind of migration more towards the value side of the equation. When we look at value as of yesterday, like large cap value as an example, is down, I use the term relatively speaking, only 8.8%, whereas large cap growth as of yesterday is down over 26%. So we're seeing this pretty significant disparity of returns between more value-focused managers as opposed to more growth-oriented managers. You know, several managers we have in the UMaine plan is more high growth, and so as a result of this, they're certainly struggling in the current marketplace. And I guess last, before we go to the UMaine plan review, it is perspective. Again, this was really as of the end of March. But if you look at the S&P 500, it is a reminder that, yes, while we don't like negative performance, and certainly folks that are in a window of retirement, it's certainly been challenging, stressful for sure. But when you look at the last 5 years, the S&P 500 on average was up about 16%. The last 10 years, 14.6%. So in a long-term view, while we don't like this bear market situation that we're in, it's certainly the last several years we've been rewarded overall. And I do think that's warranted to keep in mind as we look at investors. Any questions before I move on to the specific UMaine review? So I guess a couple things, you look at the overall plan. It's obviously we've seen some deterioration. We'll see further deterioration unless something unforeseen happens between now and the end of June. But about $1.9 billion in assets. You can see where they are roughly in terms of the overall portfolio. Certainly the Vanguard target date funds are not immune to negative performance, but the whole purpose of those is a basket of well-diversified portfolios. So it does minimize some of the risk associated with investments within that particular strategy. But the TI traditional still represents about 28% of the overall assets. I will say, I don't know if you all have seen this recently, but TIA has come out and increased the rate. It is now 5%. So folks that are investing in TIA traditional, in the floor rate now, or the crediting rate, is 5%. So, for those investors that are within that window of retirement, certainly this is a consideration in terms of your overall allocation and how much you should place into a fixed account vehicle like TIAA. But about 14% of the assets are in the Vanguard retirement series. If we look at the assets in frozen legacy annuities, if you recall a number of years ago when we created our structure, there were a number of TIAA accounts, that individual contract accounts that we did not fill, we weren't committed to, so we decided to freeze those assets, and so that's still about $130 million in assets that are sitting in those legacy annuities. And then self-directed brokerage, that was really important when we looked at the consolidation effort that we did a number of years ago. There's roughly about $41 million, or 2.18% of the assets in terms of the brokerage window. So let me just flip forward to the scorecard. So if we look at a fund, the only fund that's not scoring above an 80, again, our 80, it would be in good standing, is the Virtus Certix Mid Cap Value Fund. We have no particular concerns on this particular fund. Yeah, they've had some exposure to growth, although they're more of a relative value manager in a market that's really not rewarded relative value managers, and so that's had some underperformance as of late. No particular concerns on that fund. The PGIM Total Return Bond Fund, that fund is scoring an 85. They're a little bit longer in duration in a market that's rewarded a little shorter in duration. So, and they're a pretty active manager, but longer term performance is still very, very solid on that front. But we're not immune to negative performance. Many funds, especially on the growth side, have the numbers don't look particularly good. Like your Pacific Growth Fund had some issues. American Century Emerging Markets, it's a relatively new fund in our portfolio. They had fairly significant in relative terms exposure to Russia. They had a slight overweight to China. So in those, with some of the China lockdown policies, it's been a pretty significant headwind to them. It's still, we're fully committed to the strategy, but short-term performance has been a little bit challenging for that particular manager. So other than that, again, the Vanguard target date funds, we talk about this often, well-diversified portfolio. They're scoring a 92. We don't have any concerns whatsoever with Vanguard. They've had a slight because they look at equities in a global perspective. Prior to 2021, they were slightly underweight US as opposed to international. But if we look at more recent performance, that's really rewarded participants having a little more exposure to international developed as opposed to domestic US equity. So overall, really good long-term strategy. So I will stop there for any questions. If I need to delve into any other items, certainly would be willing to do so. I'll stop sharing my screen. Not pretty. It's just not pretty.
No, definitely not. Any questions for Barry, Mike? Well, that being said, thanks so much. Always enjoy your perspective on the markets. Well, thank you.
Thank you, Kelly.
Thanks, everyone.
Take care. And on to tab 2, enterprise risk management, and Gretchen.
Good morning, everyone. I will go ahead and share my screen. All right. Today I have an overview of enterprise risk matrix, the enterprise risk matrix, and the one risk assigned to this committee for oversight. Overall, we're currently monitoring 20 enterprise level risks. Each one of those risks has been assigned to a trustee committee for oversight. In addition, we've also assigned a management locus of control. This individual is responsible for helping to identify control strategies as well as implement them for the identified risk. So the next 2 slides just give you a high-level overview of the enterprise risk matrix. Today, we'll be focusing on risk number 9. The next slide is our risk heat map. This is a visual depiction of the overall risks based on their materiality, so the financial impact and the scope, which is the likelihood. Those risks identified in the upper right quadrant present the most risk to the university, and those in the lower left quadrant present a lower level risk to the university. Today, we're focusing on risk number 9, which is a portfolio underperformance relative to the benchmark, as well as a material investment decline. As we looked at this risk, the control strategies that are currently being employed include an annual asset allocation review in the winter, We also have the investment committee oversight and transparency, which includes regular reporting. We also have a consultant that provides third-party advice in addition to conducting due diligence performance reviews for all the investment managers. Each portfolio is also assigned a return objective and reviewed regularly to assess the performance based on the objectives and the benchmark data. But how did we come to the materiality score and the frequency scores you see here? Well, that's where we come to the next slide, which is where we worked with our third-party consultant to assess the data and what was the probability of a one-year loss of $10 million or greater. You can see that highlighted in the middle column where it's allocated out by each pool or fund, and then we get to a total portfolio assessment of 24.2%. However, as you heard earlier, we do note that we invest for the long term, not just 1 year. So there is a 5 to 7 year expected return indicated in the first row as well. All right. Overall, risk management is committed to providing regular updates to the board committees. We'll be attending the Academic and Student Affairs Committee next in August, and then in October, providing a more comprehensive review of the control strategies for all 20 risks. That concludes the presentation. Happy to entertain any questions people may have specifically around the control strategies or anything else risk management related.
Any questions for Gretchen? Thanks for the great work, Gretchen. Appreciate it. And moving on to tab 3, Kelly Regan, performance reviews of the MIP pension fund and operating fund. And I think I guess Kelly for the first time this week in, was it 2.5 years, 2 years? So it was really nice to get together with you and Jay in Boston. Great conference. Appreciate the invite.
We appreciate you and Tracy coming. It was great to see everyone in person for a long time, and I really had a lot of fun catching up with everyone. So it was great, Kelly. Thank you. Good morning, everyone. I hope you're all well. I'm going to share my screen. Okay, can everyone see this? Okay. Sorry, let me just get my, can't see all the faces. Okay. So I'm just going to start, Kelly, you gave a nod to this, but just in the materials, there is a page that we did hold our annual investment conference in Boston these past 2 days. We had about 200 clients attend, a lot of NEPC consultants like myself and folks from our research team. We did have outside speakers like Jeffrey Gunlock and other speakers. We had a great speaker from the owner of Life is Good come, and we have some of those main presentations recorded in those materials. And so I'm going to pass those on to Tracy when they become available if anyone's interested in listening to any of those recordings. So I just wanted to let the full committee know that you can still participate in our conference even if you weren't there. I am going to skip over the markets. Cap Trust did a wonderful job of updating you on what happened in the first quarter and kind of the pressure that we've seen to date, really through yesterday. The one thing I did just want to stop on, I guess say 2 things. The first is just the value outperforming growth page that I have in the deck. We show here, the top 10 periods where value has outperformed growth equities. And you can see that the first quarter of 2022 was in that top 10. So when we do talk about some of your managers who have a little bit of a growth tilt to them, that will help explain some of the underperformance that we saw from a manager perspective. The other item I wanted to stop on was just inflation. In the deck, we have NEPC's inflation outlook. It's certainly a topic that is driving markets. It's driving the Federal Reserve to take action It comes from a number of places, one being the conflict overseas, coming out of the COVID pandemic, things that are happening in China. But just wanted to note that, over the near term, the next 1 to 5 years, we do believe that this inflation dynamic is going to remain high and be volatile. However, over the longer term, we do think that inflation will normalize to about that 2.5% level, given a number of dynamics such as demographics and so forth. And so for portfolios like yourself, one of the things that we do is try to remain diversified. Equities over the longer term can do well in an inflationary environment. Certainly we're seeing pressure on them today. Things such as Treasury inflation protected securities can do well, and you do have an allocation to that in your portfolios. So again, we're monitoring the inflation path, but we do think it'll be volatile and relatively high in the near term. Moving on to the performance review for the operating fund. You can see here that we have assets of just under 345 million. We have our assets invested across our 3 pools, our liquidity pool, which is all money market funds of about 38%, our income pool, which is diversified fixed income, around 42%, and then about 20% to the total return pool, which is a mix of equities and asset classes such as global asset allocation. So not very aggressive total return, more of a conservative to moderate approach in this total return pool. When we look at assets over the quarter, this is about a decrease of 36 million, increase of 36 million from the previous quarter. And when you think about this asset allocation versus your investment policy statement, these weights are within ranges. In terms of performance, again, this is just through the first quarter. Assets were down almost 2% during the quarter. We did see fixed income yields rise during the quarter, which did put pressure on fixed income prices and also pressure on equities in the total return pool. Over the longer term, if you look at the composite, which is the operating fund results, over the 1, 3, 5, and 10 years, we have absolute positive performance and also absolute relative performance versus the benchmark, which indicates that managers in this pool have done well over the long term. There was one new manager announcement, and I'll touch on that later in this presentation. In terms of the pension fund, we have plan assets of around 23 million. There was an outflow of about 990,000 during the quarter and investment losses of 1.2 million during the quarter. So this is a decline of a little over 2 million since the last time we spoke. When we look at the performance, you can see during the quarter down almost 5% versus an allocation index, which is a passive benchmark of down a little bit under 3.5%. And I'll talk about some of the managers, specifically Walter Scott, that contributed to that underperformance during the quarter. Over the long term, specifically, over the 3 years, we have outperformed the 6.25 rate of return that we try to achieve, and in line with the allocation index, showing that managers have kept up over the 3 years. And then longer term, 5 years, still outperforming that absolute result, but falling short of the benchmark. And again, we have been trying to improve the managers in the portfolio to narrow that gap, which has happened over the last 3 years. In this plan, there was a new manager announcement, and again, I'll talk about that later in the materials. And as we always do, we rebalance the portfolio on a quarterly basis as benefit payments are needed, as cash is needed to raise for benefit payments, and that did happen during this quarter. For the, the managed investment pool, we have plan assets of 435 million. This is the most diversified pool across a number of different asset classes, as you can see in the pie chart. When we think about assets in terms of the last quarter, we had about a 25 million decrease over the quarter due to the pressure that we've seen in the equity markets and fixed income markets. You can see up here that the the pool declined about 5.8% during the quarter. There is some manager underperformance that I'll speak to. When you look at the pool results versus the allocation index, managers detracted about 120 basis points during the quarter. Longer term, over the 3 and 5 years, this pool of assets has achieved the 7.25 stated rate of return that we are trying to match. In terms of rankings, we rank the portfolio against other peers, endowments, and foundations of similar size. Over the quarter, fiscal year to date, in 1 year, just slightly below median. The results are getting better compared to the longer term rankings. When we look at the rankings, I think there's a couple things that is driving this below median. One, it's some manager underperformance, specifically in the international equity space, which, as you remember, we made some changes, or you voted on some changes at the last meeting, and those were implemented in April and May. And then also not having private equity in the portfolio. Private equity has been an asset class that has done extremely well in 2021, and other endowments and foundations do have an allocation to that. From a median perspective, the median endowment and foundation has an allocation to private equity, which has helped the results. In terms of recent actions, I just mentioned the international equity changes. So Morgan Stanley, one of the managers, was terminated in April, and we replaced that with the SSGA EFI Index Fund in April. And then Kabauta, the international small cap manager, was also terminated in April. We received proceeds recently in May, and the new manager, Axiom, another international small cap manager, is set to be funded on June 1st. Additionally, just wanted to note that NAPC worked with Tracy to rebalance the portfolio to assist with Maine Maritime's withdrawal from the pool of assets. In terms of actual manager performance, wanted to point out a few things on this page, and I know the numbers may be a little bit small, so I'm trying to blow it up here. Even though the results, on a relative basis and an absolute basis, has been negative over the quarter and over the past year, there are some bright spots. So I'm going to point those out as well, as talk about some of those managers that underperformed. But specifically in the domestic small cap area, Westfield and DFA, your two small cap managers, have actually been doing well on a relative basis. If you look over the quarter, you can see that both managers outperform their benchmarks, and both managers are ranking in the top half of their relative peer groups. And this is also the case over all time periods that you look here. So nice combination of managers. When you look at the blue line, which takes into account the combination of both managers' results, compare it to a broad benchmark, the Russell 2500, you can see that the combination of these managers has outperformed a core benchmark over all time periods and ranking above median. So one of the bright areas of the portfolio is that small cap managers are doing quite nicely. In terms of Walter Scott, this is one manager, your global equity manager that invests in US, international, and emerging, that has underperformed the benchmark over the recent quarter and fiscal year to date in the trailing year. It's a newer manager in the portfolio. I will point out over the fiscal year to date and the 1 year that versus other global equity managers, Walter Scott on a relative basis has been ranking very well in their peer group universe, even though they're underperforming the benchmark. A few things in their portfolio that haven't been working well is mostly their Japan holdings, some of their stock selection in Japan. And also this benchmark, the MSCI World, is a benchmark of US and international developed holdings. And Walter Scott did have some emerging market equity holdings, which underperformed the more developed benchmarks during the recent time periods. In terms of international equity, Morgan Stanley and Kabauta are the two managers that are no longer in the portfolio as of April. You can see that Morgan Stanley, a more value-based international developed manager, still underperformed the MSCI EFI of 5.9% during the quarter in a market where value was doing much better. So I do think it is good that we did vote to replace them with an EFI index going forward. And then Kabouter still continues to struggle over all time periods. And again, I think it's a good time, although it's hard to take the losses and realize them, to replace them with a manager who over the longer term we think will provide better value. Emerging markets equity on a relative basis versus peers has also been a bright spot of the portfolio. You can see that over the fiscal year to date, 1 year, 3-year time period, the combination of Aberdeen and Mondrian together have been ranking above emerging market peers. Specifically, Mondrian has been an add to the portfolio relative to Aberdeen. You can see that their results are much better than Aberdeen's results over all time periods, and ranking very well over the last 1 and 3 years versus their emerging market peers. So very happy with their relative peer performance, and then the combination of having their small cap exposure into the portfolio. They certainly have underperformed their stated benchmark, however, and one of the reasons for that is they don't have any energy exposure, and that is one of the areas that performed well during the quarter. Moving on to fixed income. This is another bright spot of the portfolio on a relative basis. If you look at the total fixed income line of about 98 million, which combines all of the underlying managers, you can see that over all time periods, these ranking numbers versus other fixed income funds have been better than median, really around the top third or better, and providing value over the Barclays aggregate, which is the basic benchmark that portfolios invest in to get fixed income exposure. And some of the positive performance has really come from some of the TIPS exposure in the portfolio through the Vanguard Short-Term Inflation Protected Securities Fund, and then the BlackRock Strategic Income Opportunities Fund, which has been ranking well versus other credit peers. And then in terms of diversifying assets, we have Newton, which is a global asset allocation manager, and Lighthouse, which is an equity hedge fund manager. Specifically, when you look at their results, over the last 1 year, Newton has been relatively positive when there's been some pressure in the markets, and Lighthouse has been outperforming their benchmark and actually positive during the quarter when we saw some pressure on equity. So these are some diversifying managers to help protect assets during market declines. If we move on to the pension, a number of these managers are in the managed investment pool. So I'm going to call out a couple managers that are not. The first being Baird. We invest with Baird to get Barclays aggregate exposure in the pension fund. In the managed investment pool, we do use common fund. So there is a difference in the managers. This is a newer manager in the portfolio. We did go more active. Prior to this, we had a Vanguard core passive index. And more recently, Baird has underperformed. When we think about Baird, they do try to, over time, invest in more credit assets versus the benchmark. And we did see credit spreads widen out and some poor credit performance. And so this did not help their portfolio. Over time, what we see from Baird is that they do have great positive credit selection. And over time, I do think that these results will go back to normal. And then lastly, Principal. Principal is one of the real estate managers, which has been a value add to this portfolio. You can see all the positive performance that we've seen out of Principal, really diversifying this portfolio in times where both equities and fixed income don't do well. Real estate, and specifically Principal, has added value. And then lastly, the operating fund. Here we have managers that are doing quite better compared to the other pools. We have Income Research and Management, which is a shorter term government credit fixed income manager, outperforming its benchmark, ranking very well versus other short-term bond peers over all time periods. And then also PIMCO All Asset. This is a manager that has exposure to commodities and other diversifying assets. And, I didn't mention it, but commodities has been the one area that has done well in 2021 and 2022. And PIMCO has benefited from that. You can see over the 1-year time period, up 6.5%, really more than what the global equity index of 6.1% has done. And on a relative basis versus its benchmark, it has done well and has done well versus peers. So quite happy with that allocation in this portfolio. I mentioned there were 2 manager updates on the due diligence monitor. We have here Vanguard tips with a yes on recent manager changes and IR&M on yes on a recent manager change. In terms of Vanguard, we had the fixed income CIO retire and replaced. He was there for 32 years, replaced by the new CIO, which is Sarah Devereaux. And with this, NEPC has spoken with Vanguard, and we have a no action on this change. So it's really just an FYI for the committee that there was a change with Vanguard, and this really just impacts the tips, the passive tips mandates that you have. And then within IR&M, they have co-directors of credit research. One of the co-directors did leave. So the other co-director is going to become the sole director of credit research. And when we think about IR&M, they've always operated in a team approach. They have a great team culture. And as NEPC's research looked into this change, again, no action. It's just a 4-year information on the one manager that's in the operating fund. So I will stop there and see if there's any questions on performance. Okay. Hearing none. Kelly, is it okay to move to the next section, which is ESG?
Yes, definitely.
Kelly, sorry, just one. Could I come back with a question? I'm sorry I'm late on it, but I just sitting here trying to think, and this is a tough question, I'm sure. But how should we think about these different funds that we have over the next year to 2 years? We look at the rest of 22 and into 23. I know you have a lot of great data, and we can all calculate the standard deviations and make calculated risk. But how should we, from your view, Kelly, how should we be thinking about them? Are they going to be going down 2 to 3% per year for this year and next year, or should we be thinking? I know it's a hard question to answer, but at some point we got to come back to thinking about how much do we draw from these funds and apply them during the next year or two in terms of the operations.
Sure. It is a tough question, Mark. It's a good question. There's a lot of uncertainty across markets.
Right.
And when I think about the managers, we have hired managers where they have a solid process, they have a good team in place, they're strong firms. Managers such as Walter Scott, J.O. Hambro, they are investing in high quality companies with strong balance sheets that have long-term growth potential.
Right.
So certainly, these investments come with volatility, and we're seeing that now. I think if these managers stick to their process and what we hired them for over the long term, next 3-5 years, I think these managers, will show us results that are more in line with expectations. Certainly, I think that having a mix of active and passive continues to make sense. Certainly in volatile times, these active managers hopefully can add value by continuing to purchase securities that they believe are of value at some of these dips that we're seeing here, and over time adding value to the portfolio. So I think as long as we don't see anything material change in terms of things from a due diligence perspective, teams and process, and they're sticking to what we hired them for, I think over the longer term, I think we're going to see some value out of these managers. But understanding that, these are equity managers, these are emerging market equity managers that are just come with volatility, in the markets that we're seeing more recently.
Yeah. So in the near term, it would be wise to think that probably the performance would be close to what they've been doing in the near past. So obviously none of us can predict where the market's going to go, but if we see the markets continuing to perform where they've been in general, our performance as you just gone through and shown how all the active managers and the composites have been performing should stay relatively in that same relationship to the overall markets, is what you think would happen in 21, 23. I mean, 22, 23, excuse me.
Possibly. I do think if we have a little bit more of a return to growth, some of these managers will do a little bit better than what we've seen in this value biased market.
Yeah.
So that could improve if that dynamic changes. If the dynamic that we're seeing currently right now where value is outperforming, and I think that this dynamic that you saw in this quarterly report may continue for a little bit.
Yeah. Thank you. Yeah. Tough question. It's a hard one to answer. None of us has the answer, but I was just trying to wanted your view on it. Thank you.
Yep. Anytime. Okay. I'm going to move to page 212.
Kelly, can I just ask a follow-on question there? And you said some of the managers do have that growth tilt. Is that their mandate or is that their decision? I mean, do they have the opportunity to move some to value if they choose, or did we hire them to have a growth tilt?
Sure. So Walter Scott specifically, and J.O. Hambro are two managers. They're not aggressive growth. They are managers that are high quality growth. So they're not really growth per se managers that we hired them to be growth, and they have the flexibility to go both ways. I would say they're more GARPy, where they're growth at a reasonable price. So there is a value component to them. So I do consider them a little bit more core and not full on growth. But when we do have this dynamic and they do have a little bit more of that growth exposure, they will be affected by it. Okay, any other questions on performance? Thank you for that, Tracy. Okay. So here I have a summary. I wanted to update the committee on a number of things on what you've been doing in terms of what I'll call impact investing. Impact investing, and how I view it as a broad term that encompasses ESG, and encompasses negative screening through the divestment. And so I just did want to update the committee on a few items. One, I wanted to update the committee on specifically the managed investment pool's fossil fuel exposure. There has been some commentary through comments at board meetings, over news about kind of why the fossil fuel exposure has declined in the managed investment pool. So I kind of wanted to bring the committee up to speed on really kind of the drivers of that fossil fuel decline over time. And then I also wanted to show you a new tool that we put into this presentation, which I'm calling our ESG Dashboard. And just to kind of level set specifically the managed investment pool, as that up until recently has been the pool that has had ESG in its investment policy statement. Just wanted to show you where that ESG sits in the pool. Before I get into that, I do want to update you on Kelly's comments about the direct divestment from fossil fuels. So as an update, as you remember, we have two separate account managers, Westfield and IRNM, who we can direct them to no longer invest in fossil fuels. Westfield's in the managed investment pool, one of your small cap managers. So we did work with Tracy and have submitted an amendment to the guidelines where they can not invest in the Carbon 200 going forward. They did not have any securities to divest from today, but going forward, they have been directed to never hold securities in the portfolio going forward. So that is all set. Within IRNM, that's your short-term bond manager in the operating fund. They had two securities that were about 50 basis points of their portfolio. So it was about $400,000. So it was about 10 basis points of the total operating fund portfolio. They sold their two securities, Canadian Natural Resources and Pioneer Natural Resources, that were in the Carbon 200 list on May 10th. They sold those two securities compared to what they purchased them at about a $13,000 loss. The cost to sell those securities was relatively low. The transaction costs were about $275. So relatively minimal cost to sell those securities. And they did purchase two securities to replace the securities that were sold at what they believe were fair prices and good adds to the portfolio given the securities they sold. We also amended their guidelines, and I worked with Tracy to amend their guidelines. So going forward, they can no longer invest in any securities in that Carbon 200 list. So I'll stop there and see if there's any questions on that before I go into the next part of the presentation. Okay. So here on this page is just an update on the fossil fuel exposure in the managed investment pool. And I took this back to 2014 and rolled it forward to more current at 2021 when we last estimated the exposure of the pool. And what I wanted to note was that, from 2014 to 2016, another period when we measured the fossil fuel exposure, you can see that the exposure started at 6.5% and declined to 3.3%. During this time, the committee voted to divest from coal. And there has been some commentary that the coal divestment was the sole reason for this reduction of 6.5% to 3.3%. And what I wanted to show you was that that's not the case. Back in 2014, when we poll all the investment managers in the program at that time and asked them what their fossil fuel exposure was, we were, in the beginning stages of these divestment discussions, really across, universe, right? And so managers responded to NEPC with one of two things. They either gave us their fossil fuel exposure based on their definitions of what a fossil fuel was, or they just gave us broad energy exposure, which incorporates fossil fuels. And so at that time, the exposure was relatively high. And part of the reason for that was just that broad energy sector exposure that we were receiving from the managers. In 2016, at that time, the managers no longer gave us their energy exposure, but the managers gave us their actual fossil fuel exposure based on their definition. And what you can see in this chart is that change in definition on what we were receiving from managers accounted for the majority of that decline in fossil fuel exposure. And so, I think going forward, as we look at how fossil fuel exposure has changed in the managed investment pool, I would advise that we start with this 3.3%, which is the real fossil fuel exposure across the board, apples to apples, compared to how we move forward. In 2021, we estimated, again, going through the investment managers, asking them what their fossil fuel exposure was. And they, when we look across the portfolio, that was 1.8%. And so down here at this chart, I wanted to show kind of what the driver was of that change. One is third-party manager decisions, down about 60 basis points. And when I say third-party manager decisions, I mean, for example, and I'm just going to use this as an example. It's not actually true, but let's say Aberdeen. Aberdeen gave us an exposure, let's say, of 5% back in 2016. And in 2021, they're at 1%, right? So their actual decisions, their investment process decisions on what securities they're going to select brought down fossil fuel exposure. Also, manager replacements. Over this 5-year time period, the investment committee has selected new managers and terminated other managers. Those new managers that were selected tended to be more ESG, and managers such as Walter Scott, for example, tend not to hold fossil fuels. So some of those manager replacements also reduced the fossil fuel exposure. Asset allocation changes also reduce fossil fuel exposure. For example, moving a little bit from the S&P 500 index into Walter Scott, a more global equity manager that does not hold fossil fuels. So those asset allocation changes as we move from US equities, international equities to other asset classes, whether it be fixed income or whatever that move was during this 5-year period, did result in some decline to fossil fuels. And then you have the combination of both. Asset allocations changes and manager changes going hand in hand, and that noise that goes around that result in about 60 basis points. So going from 3.3 to 1.8, all of this was not due to any coal divestment, any other type of divestment. It was really due to, one, asset allocation and manager changes, a lot of it with an ESG lens, and then two, what the actual investment managers were doing. So I'll stop there and see if there's any questions. I thought it was important to clarify the decline in fossil fuel exposure. And before I take questions, let me say one more thing. We have been asking the managers what their fossil fuel exposure is. Going forward, given that your specific direction is carbon 200, I will be now asking the managers, what is your exposure to the carbon 200 list? And that could potentially bring this down if managers had been giving a wider range of fossil fuel exposure compared to what the carbon 200 is. So I did want to point that out too.
Thank you, Kelly. Does anybody have any questions in regards to Kelly's comments?
Kelly, I have a question. Just wanted to clarify also, this is in part presented due to the comments during public comment period at the last board meeting, because I think there was some confusion about how they were interpreting the changes in fossil fuel percentage over time for lack of clarity. So it's to really, define what the drivers of those changes have been over time, and recognizing that going forward, the definitions have changed as well. So whenever there's analysis, it will should take that into consideration.
Thank you, Tracy. Any other questions, concerns, comments in the room? Okay. Kelly, are you still presenting?
I have one more slide that I wanted to touch upon, if that's okay.
Sure.
So ESG Dashboard, this is just for the managed investment pool. We've been doing ESG since 2017. So I really wanted to show, how this really, kind of show you a starting point. So as we continue to do ESG and, move forward on the fossil fuel divestment path, really kind of show you where we are at this point in time. And as we look at this, in the future, kind of see how we've progressed. So up here, in terms of the percentage of assets, when we look at the total MIP assets, and we look at the managers that are in the MIP, we have about 67% of those managers that are PRI signatories, so have signed on with a PRI. We have about 86% of assets across managers where those managers incorporate ESG into their investment process. And the definition of ESG integration is based on NAPC's scorecard of how managers incorporate ESG. So we have an impact investing committee and a research team that evaluates managers. we rate those managers on a scale of 1 to 5 on if they're good managers to invest in, right? Based on a number of characteristics. We also rate them on a 1 to 5 on how well they incorporate ESG into their process. And so a rating of 1 is the best, a rating of 5 is the worst, 3 is neutral. So for your managers, 86% of those assets that they oversee are rated 1 through 3. So this is a very strong percentage of your portfolio that has strong ESG integration. When we look down into the actual managers, we have a table down here. And I, plotted on how many managers rate in each one of those 1 through 5 categories. You can see that you have 6 managers that have a 1 rating based on NEPC's assessment. 2 have a 2 rating, and 3 have a 3 rating. So the majority of your managers are rated very well on an ESG perspective. None have a 5 rating. There's no, orange box here. And then 4 have a 4 rating. And I did want to note that 2 of those 4 managers is the Vanguard TIPS funds. So 2 TIPS funds, 2 out of the 4. And really it's given a 4, not because of the strategy, but just because of the firm overall. It's a firm rating that we have on Vanguard and how they incorporate ESG across their passive strategies. When you think about TIPS funds, it's all treasury based, right? So there's really no ESG rating to have. Their ESG ratings on securities really come from equities and corporate bonds, not so much treasuries. So I do think that this is more of a 2. And I think going forward, I'm going to note that a little bit better, just to let you know that the majority of your managers in the portfolio do rate well. And I'll say that our scorecard, and from my perspective, it tries to get rid of that greenwashing that we see out there. Managers coming in saying that they have an ESG fund, or the fund's called XYZ ESG fund, it has it in its title, but do they really incorporate ESG? And that's what our scorecard is trying to get at. And then 1 is showing that it's in their process. They have a strong team of analysts looking at companies from an ESG perspective. They're signed on to the PRI. They involve themselves in other type of sustainability type initiatives. They engage with companies, things of that nature. What are they really doing to show that they're committed to ESG and put that in the portfolio? So I wanted to show the committee this just because it's a newer tool that we have. Going forward, we can do this for all 3 pools of assets because we did adopt ESG language in all 3 pools of assets. But just did want to show you this and talk about this a little bit and see if there's any questions or thoughts from the committee on how I presented this today, and if it's helpful.
Any questions, comments, concerns?
Kelly, it's me. I think it's good. I think it's very helpful. It's good information.
Great. Thank you, Mark.
Kelly, David McMahon, do you have any correlation between the highest rated ESG and performance against peers, performance against benchmark?
I can follow up with that, David. So yes, I can take the flash report that we walked through earlier and then put the rating next to the manager to kind of show you kind of how those 1 rated managers have been doing versus benchmark and peers, and can take that comment and maybe going forward kind of show that a little bit better. But yes, I can follow up on that.
Well, thank you, because I think that would be very useful information.
Ellie, just a quick question. This is Matt. The SEC has kind of come out and said that they're going to start cracking down on a bit of that greenwashing that you referred to. Do you think that will make it harder for us to find enough managers to kind of move in this ESG direction that we've been moving in, particularly with the fossil fuels, or will it actually maybe make it easier because the disclosures will be better and you'll be able to find managers that are truly doing the ESG a little bit easier? What's your take, and will it impact your process at all? Because I would imagine it would probably impact the way that NEPC also defines and holds itself out there as an ESG consultant.
I think more transparency will be good for the overall industry. I think our process is pretty rigorous already in kind of weeding out a lot of that. So I'm not sure that it's going to impact how we rate these managers going forward. I do think that our process really kind of has gotten rid of the greenwashing aspect from our perspective, and really knowing what our managers that we recommend to clients, our preferred managers, really what they're doing in the ESG space. So I don't think it will have much of an impact there.
Great, thank you.
Anybody else with questions, concerns? Well, Kelly, I want to thank you for that great presentation. Space is growing and evolving, and so we really, really value your guidance through all this. It's not an easy, it's not black and white. It's definitely, there's a lot of complexity to it. So really, really appreciate that.
Thank you. It was good to see all of you.
Nice to see you as well. Anybody else have any questions, concerns from the meeting today? I get to be the good person and give you 15 minutes back of your day. So the meeting is adjourned.
Thank you.
I'll see you guys. I'll see some of you on Sunday. Look forward to seeing you.